Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for October 2nd of 2023. To start off this week, I thought I'd show you the CFO Survey Index here. This is from Duke University and the Federal Reserve Banks, both Richmond and Atlanta. Very interesting viewpoint that we're getting here from chief financial officers that are looking at the overall economy in that blue line. The optimism has certainly picked up as of late after a fairly prolonged period, as you can see, of decline, and also as it relates to, their own company, after a period of decline, seems to have kind of flatlined now. But I wanted to start off with a little bit of optimistic news here. At least you got CFOs that are a little bit more optimistic and continue to trend upwards in their view of the overall economy. The probability of recession, you can see where that has certainly picked up. And is now in decline. Now, that's something that we've been watching over the course of several months. Major investment banks have kind of reduced their own estimates. Right now, we're looking at something that's akin to around 30% probability of recession. You can see prior cycles where we've seen perhaps larger spikes in that probability indicator. Now, we never did get up to 60%. That seems to be kind of a bellwether as far as where recessions are likely to actually manifest. We can see here, the shaded bars represent those actual recessions as dated by the NBER, but you can see we're not up at the level that we were at in 2006, 2007, but we did have a recession. Obviously, the pandemic was something completely different, but here we are at kind of, we peaked at like 45%-ish, and we are definitely on the decline. Now, good news is, as of this recording, we do have a deal to avert a government shutdown, one that was bipartisan. Speaker McCarthy had to appeal to House Democrats, and they got that done. Now, obviously, there's a lot left to be discussed with regard to his future and future legislation, so on and so forth. But, before we kind of completely leave this shutdown topic, I thought I would just highlight a couple things. This chart you haven't seen before. The next one we included a few weeks ago, but just as it relates to shutdowns, I think it's just kind of interesting to have this information in your hip pocket, because I do think the contention levels in Congress are still pretty high. And all we really did with this interim agreement, presuming it's signed by President Biden, is kick the can down to December. So here we have prior shutdowns going back to 1977. Average duration you could see here is 8 days. Last time we had a shutdown was just a few years ago, and that did last a little bit more than a month, but only a fraction of the government was actually shut down at that point. And there's a lot of conversation that lies beneath that. I mean, what actually stops happening and what still gets paid, and obviously entitlements, Social Security, those things don't stop, but a lot of the other things do, like SBA loans and national parks and so on and so forth. But anyway, you can see here that typically they don't last very long at all. And we have here, you saw this a couple of weeks ago, and I'll just kind of first point your attention to the middle of this. So obviously, we're not likely to have a shutdown now with this agreement, but you can see here the impact of that was maybe if it lasted for a week, we'd have like a 0.2% impact on overall economic growth. Now, what's left to be decided here is on the left-hand side for student loan payments, and we know that those are beginning this month, and we'll have to wait and see. The anecdotal data that we'll get on retail sales and consumption here over the next 2 months, I think will be pretty telling. Now, and also, as I discussed a few weeks ago, when you saw this, the UAW strike still is ongoing, and not real sure what that resolution is going to be. Now, the impact there is not that great, and I'm going to show you a chart next that kind of gives you a sense of why maybe the impact of that UAW strike is going to be even less than we thought, assuming, of course, that the strike gets settled before too long. And here is that chart. So inventory to sales at motor vehicle dealers is actually in a reasonably healthy way, right? It's not at pre-pandemic levels, but it's certainly up above where it was. So when you kind of look at, what's the impact of a shutdown of plants and obviously parts and suppliers and distributors and things like that, it over time it will have a fairly stronger dislocation within the inventory market. But right now, and I heard several stories on this last week, that dealers are reporting that inventory levels are actually okay, that there's product to sell, and you can see here that the inventory to sales ratio is certainly above where it was at the peak of the supply chain problem. We'll talk about the federal budget deficit here. This is just kind of a trend line analysis going back to 1962, and it shows you the distribution of where that budget is going. And we do know that the overall majority of it is going to mandatory spending, and you can see the spike related to 2020 is, of course, the stimulus payments and what have you there. Net interest is obviously come down over time because we know that net interest cost, because interest rates were lower, right? And so that is going to, that's going to blow out. It's certainly going to increase over time. And so you can see defense and non-defense discretionary. Really, those are the only categories representing maybe 7.5% of the federal budget. Those are the only items that are really up for debate right now. And we'll talk about gross domestic income and gross domestic product. Now, about a year ago, I talked to you about the differences between these two, and really the kind of the anomaly that existed at that time, that GDI, gross domestic income, was above GDP, and that was one reason why we felt like we were not going to see really any kind of a recession last year. And that has actually reversed this year, and I'd say, looking at the revised numbers, they're still pretty close to each other. And ideally, these two things should be the same, because one person's production is another person's income, and vice versa. There, these things should lay on top of each other, but there are various anomalies at play here. And so when you look at this, obviously what's being reported in GDP, what we're likely to get at the end of this month is a pretty strong quarter, right? But income is falling a little bit below that from a revised standpoint, but it's really actually pretty close. And so just as we saw income above production last year, that production over income this year, I think there are some people that want to make a case that that this means that GDP is being overstated, but I think the numbers are still really close enough to really not make that distinction yet. Now we'll turn our attention to money supply. I have not shown you an update on this in quite some time. This is from Charlie Bolello and his chart pack. This time series that goes back to 1960, you can see here very clearly that up until recently, we've not had a negative number in this data series. And, there have been certainly periods of rapid money supply growth, which is usually correlated to higher inflationary periods, and then obviously slower periods that correlate to Fed tightening and kind of coming out of recession, where the conditions are a lot tighter. Well, I mean, just like the metaphor that we've used before with the pandemic is like throwing a big rock into a calm pond, and you're having all of these ripple effects. And so we had a blowout money supply with all the stimulus payments kind of during the middle of COVID there. You can see that huge spike. And then just like that big rock hitting the pond, you're going to have the ripple effect. And so now we're seeing the other side of that with negative money supply growth, which is pretty astounding in its own right. But one thing that's not being really discussed right now is the impact on inflation. And so the nature of money supply, if you pull that punch bowl away, you're going to work your inflation numbers down over time. And I think that's really at play here, and is not getting as much conversation, but it's helping to drive that inflation number down. Another thing that I think is really important here too is rents, and you consider owner's equivalent rent as a significant part, 35 or so percent of core inflation. And we've had some conversation, in these chart packs over, over maybe the last half year about like rents that are observable in the databases as opposed to rents that are in owner's equivalent rent, which is imputed, which is a different calculation altogether. But over time they tend to coalesce, and so what we're looking at here is actually a negative year-over-year change in monthly rents. And this data comes to us from Apartment List, which is a market database. So the good news here from a cost standpoint is that the rent component of overall uh, uh, core inflation is coming down. Again, another one of these things that's helping to drive inflation lower. And here we have retail gasoline prices priced in today's dollars with a data series going back to 1976. You can see how this does oscillate over time. We know that we've got higher gasoline prices right now, and this data series also takes projections out into 2024. Expected that prices go down, but actually not getting back to the lows that we saw during the pandemic and even back in 2016 when we had pretty low pricing from a dollars per barrel standpoint of crude oil. But I think gasoline prices are expected to remain fairly sticky up here. Again, this is not an item that sits in the core inflation number. This is part of the overall basket. I think the comment, or I guess the takeaway here is that gasoline is a pretty visible component of spending. Things that drive our emotions when we go to the pump, and we know that we're paying like $30 more to fill up our gallon. I mean that's palpable, and I think to the extent that that retail gasoline prices remain sticky up here is something that the Fed is going to continue to watch, and and kind of track and monitor as well. Now, every argument has another side of looking at it, and I thought I'd show this information from Goldman Sachs, and it shows you the share of personal consumption expenditures by these various selected components. And you can see here motor fuel, while being significant maybe on the conscience, is not necessarily significant statistically as a percent of total PCE. You can see here that's 2.3, and electricity goes down a little bit more than that. And obviously, food is much more impactful than any of this. And food itself is pretty visible, but at least when we're talking about gasoline, and I think the idea is not to get too caught up into it. It's just that from a psychological standpoint, it's more impactful when when you go to the pump and you're filling up your tank and you realize, man, that's $35 more than I remember paying 2 months ago. That's pretty impactful, but from a data standpoint, it's not that significant. Here we have some more pass-through information to core inflation, and you can see here, this is just kind of a trend line from some of these commodity level areas, and you can see that the overall impact and the various categories here, you've got lumber, ag, precious metals, industrial metals, and energy, really not having a significant drag on overall GDP, even though these prices are a little bit higher. Here we have annual premiums for health coverage, and this is something that just continues to rise. And these are pretty compelling statistics, and you can see here that the cost to the employer continues to go up at the same time that the share of the workers' contribution is going up as well. And so I think that's a trend that unfortunately is going to continue, and frankly is driving a real big benefit to the large insurers like United Health, et cetera. And but interesting couple of slides here from the Kaiser Family Foundation. Here we have data from the Commerce Department that shows spending on drugs. If you talk about things that are really going to have a more meaningful impact necessarily than gasoline at the pump, it's going to be these things. I mean, the health insurance and your share of it as an employee, or prescription drugs, as you can see here, that this is clearly, a non-linear increase here. That it's almost a bit parabolic in the way that it's rising. And so, the question is this really sustainable? And where is the reckoning going to happen, and when is it going to happen? And we'll switch our focus here to real rates. You can see how they've tracked higher. This data series goes back to just before the pandemic started in January. And you see this rather pronounced rise. And, as these rate increase trends go, this has actually been pretty linear. Now, we did have a hiccup in 2022, but overall, the trend line going back to the summer of 2021 has actually been pretty straight up for all of these. You've got three different data series here. You've got the, kind of the 10-year forward rate, the 20-year forward rate, and then what we call the 5/5, and that is really the 5-year estimated forward rate 5 years from now. Continuing the conversation with rates, we look at Fed funds, which is the short-term interest rate that the Fed controls, that we often talk about, when we say short-term rates. This is kind of the proxy for that. So you can see where that's now up to 5.25% at the lower bound. Now they're a little bit higher than that. And obviously the question is, are they done? Do they have one more rate hike? The probability right now of a rate hike is somewhere maybe close to 20%, 20 to 25%. So there's not unanimity of opinion that that's going to happen, but as we see various data points, it certainly is driving speculation. Now, if we look at core PCE, now this is core, inflation as the Fed defines it. You can see that we got that data point last week, and that's down to 3.9%. And by this yardstick, you would conclude that monetary policy is actually pretty tight right now, because you've got a Fed funds rate, even at the lower bound, which is meaningfully higher than your inflation rate. And so what does this tell you then? I mean, credit is very restrictive from that yardstick, and it's also kind of indicative of maybe foreshadowing a slowdown in the overall economy. Let's dig a little bit deeper into the inflation equation and core personal consumption expenditures price index. This is the data that was released last week. You can see in the black line on the left-hand side of the chart. The data point that we got was 3.9, which we showed you in the previous slide there. You can see the impact of housing has been pretty pronounced, although it is coming down. And of course, you can see there below that, and in kind of a slightly darker blue, the core goods line, which has been coming down for quite some time. So if you back out the influence of housing, which we know has been high, core services without that is actually pretty much in line with the core. And so you can see, inflation is not quite coming down at the same rate that it went up. That's what has a lot of people kind of a little bit bent sideways, a little bit, thinking that it's fairly sticky. But, with rare exception, I mean, that number has been trending down over certainly the last year, if not longer than that. And so that's a positive sign. And so on the right-hand side, we kind of look at the velocity of that decline. And I think this is a very interesting analysis here. When obviously at the 12-month, the year-over-year change is 3.9% at the core PCE. And so, we see that on the right-hand side in kind of that purple line. But if we look at a little bit more of a near-term basis, we see that the velocity has actually increased. So inflation rate is actually coming down faster if you look at the near-term data, not the year-over-year, but maybe the 6-month data, or certainly the 3-month data. If you annualize the 3-month rate of change in core PCE prices, that puts us at an annual rate close to 2%. We're going to have to watch over the coming months is credit quality. and delinquency rates. You can see here both for credit cards as well as other consumer loans are tracking higher. They're not at a critical juncture yet. I think one thing of note here is that at least credit cards are, to their delinquency rate is just a little bit higher than where it was before the pandemic started. And then obviously you can see that trough and then the reacceleration. So the rate of change as you look at it over the last several quarters is actually pretty astounding, right? And so that's something that gets your attention. But the aggregate levels of defaults are not at a level that you would consider to be kind of a crisis, but it certainly bears watching. Same thing over on consumer loans that are not credit card, not tied to revolving credit, if you will. Again, something that we want to monitor. Credit quality is still relatively good, but in any kind of an economic slowdown, you're going to have this type of evolution, and it just bears watching just to make sure that we're on top of any meaningful trends in credit quality. I'm not going to spend a whole lot of time on this because we talk about mortgage and housing quite a bit in this particular program. So, but I just wanted to, just show you this from TradingView and Game of Trades here, this look at the mortgage market going back to 1990, and you can see we're down to 1996 levels in terms of demand. Here we have a Bloomberg chart for you of multifamily housing starts. So these are apartment starts, and they've really fallen off a cliff lately for a lot of different reasons. Let's say, where financing has been pretty easy. Now that credit is getting a lot tighter, getting more expensive. One other article in the journal this week was insurance, liability insurance on a per unit basis for multifamily has really gone through the roof here. And so you can see its impact on overall unit starts for multifamily, which actually have been fairly strong. This is a chart of the US dollar. We know the dollar has been very, very strong over the last several months. It was treading water earlier this year after having come down quite a bit at the end of last year. And so now we're kind of back up to levels that we saw at the end of last summer. Of course, this is, good if you're, from a currency strength standpoint. Not so good if you're an exporter into foreign markets where, your wares or your goods, so to speak, are a lot more expensive. And it also puts a lot of pressure on foreign central banks to adjust their own monetary supply or monetary policy to meet the strengthening dollar. And generally what you do is you raise your interest rates, but obviously you run the risk of choking off the lifeblood of your economy if you're a foreign central bank. And so that's the conundrum that a lot of people are in right now, and particularly in the emerging market sector, where dollars are required because a lot of emerging markets are very commodity centric in terms of the nature of their economy. And so if you've got a lot of those commodities that are priced in dollars, then that creates a bit of a problem for you. Here's a quick look at money market fund assets. Continue to move higher. I haven't updated you on this in a little while, so found this Bloomberg chart, and it's clear that those balances are moving higher. Short-term rates, as we know, are moving up. Certainly all the way up to the 2-year Treasury. We know that short-term, near-term rates are even higher than that. And so you're getting money market mutual funds that are paying, like 5.5% right now. And so it's creating a huge draw from other areas of the fixed income spectrum. Talk about the U.S. stock market here. We've got the S&P 500, which has been volatile of late. We certainly know that. I mean, if you go back to the end of July, I'd say the third quarter was a bit of a bust in terms of investor enthusiasm. We had a bit of a correction. Obviously, when you have that and the size of the market that we do, it results in trillions of dollars that are lost in terms of market value. But you can see the overall direction of the market, and we're sitting about 43, 4250, 4300-ish, and which is well below our July levels of 4600. And so, but I think you'll see, at least from a valuation standpoint, in the coming slides, that we're really not in bad shape, even though volatility is certainly apt to continue. Here we have the 24-month percent change, and so this encapsulates the kind of the issue that we had last year. Markets were down quite a bit, and so I thought this was interesting analysis. That I honestly, I don't think I've ever seen this particular data series before, where it gives you a two-year kind of essentially a 2-year rolling return. And if you look at that, what's interesting here, again, for the people that are advocating for or projecting a recession, this is something that you would certainly look at. So the 24-month change is basically zero. So you account for what happened last year, and then you add the positive return this year, and that gets you to roughly zero at this point. And so, the author of the research piece that I drew this from was clearly trying to draw a tie to the 2-year rate of return to the incidence of recession. And this going back to 1970, there are certainly instances of that. And so, again, this research, none of the research should be taken lightly, but, I think we are, in some respects, dealing with a very odd circumstance here with the pandemic, and then all of the stimulus and inflation, and then the impact of that, and the fact that we were late to raise rates, and now we raised rates so quickly. And I still think we're dealing with ripples, and I hate to say, and I really hesitate to say anything about like, well, this time it's different, because usually when you say that, then you wind up right back where you've been before. So it's an interesting data piece. Just like the trend line leading economic indicator index, which is clearly supporting a recession right now, but we haven't had it. So again, you take all of this in a mosaic and process it collectively, and not make decisions or forecasts in isolation. Here we have the forward 12-month PE ratio. You can see here in the green dotted line, that's a 5-year average. So we're below the 5-year average. Forward 12-month price to earnings ratio, we're a little bit slightly above the 10-year forward PE ratio, but you can see that that is clearly below where we were looking, kind of post-pandemic, if you will. Certainly have come down, even though those multiples have gone up a little bit. If you look at towards the end of last year, heading into October, which is a trough in the market. But again, we're not terribly expensive at these levels. Here's corporate profits. We see those remaining fairly strong despite the inflationary headwinds that have long been discussed. And labor costs are very important to corporate profits, as are component costs. And oftentimes we've seen in prior cycles where rising component costs are being absorbed in terms of margins, and they're not being passed on to the end customers to remain competitive. But you can see overall, if you go back to the post-pandemic environment, you can see very clearly here that the rate of change in the corporate profits has been well above the trend line. Now the question is, as you overlay these recessionary periods, that is this going to turn? And I do think corporate profits are going to slow a bit. I think it's a natural evolution, not necessarily because of, say, rising labor costs, but I think overall demand will begin to slow as the consumer becomes a little bit more constrained. There's less excess savings for them to spend. And I think corporate America, even though, as we saw earlier, the CFO confidence index is pretty strong when they think about the overall economy, we clearly saw maybe a flatlining of expectations with regard to their own business. And I think that makes people a little bit more conservative in their spending. And I think that coupled with overall business activity perhaps slowing is going to cause this line to kind of flatten out maybe perhaps a little bit in the coming months. And here we have institutional manager holdings of equities. This is private client equity holdings as a percent of assets. And you can see that we're still above the average, even though that number has come down. And another thing that's become abundantly clear when we look at the equity markets is that international markets are very much undervalued relative to the U.S. market. And if you look at this chart, again from B of A, it makes for a pretty compelling case for diversification in overseas markets. And you can see, that we're well above a standard deviation, which statistically is extremely rare. We're we're in very rarefied air here in terms of the dislocation between U.S. and foreign markets, and it really just does beg for diversification increases in international markets. So I've shown this chart to you before from B of A. I think it's particularly interesting, and I don't know that it has any type of informational value to us, but I hopefully, as I fill these chart packs with helpful data, I also provide maybe a chart or two that perhaps entertains you. Now, these are interest rates that go back to 3000 BC, so before you start trying to, infer some real strong correlations here, this is a hugely long period of time. And I think the takeaway here is that it's been a long time since we've seen, rates on a short-term basis that were this low. You have to go back to the Great Depression, right? And we've talked about that, but, you look over a long period of time, and I'd say, forget about 3000 BC, that's not even relevant. But if you go to the colonial period, 1790, and you track, you're at an average rate of somewhere in that 4 to 5%. And it's been pretty amazing how we've seen, rates gyrate from, basically from the onset of World War II through the present. We'll talk about interest rates for a second here. We've got the 2 to 10s curve. We're still negative. We're still inverted on our yield curve. What this means is it's just the 2-year yield minus the 10-year yield. And so obviously the 2-year yield is higher right now than the 10-year. So we remain negative and inverted on our yield curve. Here's the 5-year Treasury inflation protected security, or basically TIPS bond. This is really kind of a proxy for real yield, and so that is continuing to move higher around 2%. This is good for savers in many respects, and I think it's apt to remain higher for longer. Rig counts, despite the fact that energy prices are higher and likely to remain so for a while, we're really seeing a lot of capital discipline on the part of domestic drillers. And, in prior cycles where we've seen spikes in commodity prices, we've seen kind of almost like an inflective response on the part of these independent drillers and so on and so forth, to release more product into the market to try to take advantage of that. And this time around, it's different. We've had tremendous amount of price discipline, a lot of focus on returning capital to shareholders, and so rig counts really haven't taken off. And I think this is one reason why a lot of people feel like energy prices are going to remain higher and stickier for longer, and that in and of itself is going to add another layer of introspection for the Fed when it considers inflation and overall price levels, so on and so forth. And we're going to, I think, conclude here on the labor market. What's a very interesting dynamic here in the Biden administration. We've seen a re-acceleration in work visas. And obviously coming out of the pandemic has a lot to do with that, right? So, you're obviously not issuing or granting visas when your borders are closed, but so that's changed. So we've got a lot of immigrants that are filling job gaps right now. Is helping to keep labor costs low and fill and fill the needs out there, frankly, in a lot of the trades and kind of even the semi-skilled levels, so on and so forth. But the interesting thing is that is really kind of offsetting this decline in labor participation of the elderly. And we saw a lot of those folks drop out of the workforce during the pandemic. You can see that here on the right-hand side, and those folks really haven't come back in. And so the interesting dynamic as it relates to labor market strength, and again, it relates back to what the Fed's trying to do, is kind of perhaps slow the labor market a little bit while also trying to control prices and have both of those kind of end up in a soft landing, is you have this dynamic now where you've got more immigrant labor that's filling those gaps that are very necessary in our economy. That will do it this week. I hope you've enjoyed the slide pack. I hope you have a great week, and we'll talk to you again soon. Take care. Bye.